Good afternoon, everyone. This is Greg Schenk with the Schenk Company here with you today for another podcast. Today, I'm fortunate to have Robbie Hendricks from Venture Real Estate Partners here, who is a general partner in the apartment niche. And we're going to tell you everything you wanted to know about should you invest in real estate? Should you invest in apartments? What's the difference between a limited partner and a general partner? And I'm very fortunate. I've been following Robbie for a long time online and learned a lot myself. If you haven't heard our previous podcast, I've been investing myself for about 25 years around the country. And my goal for this is to really educate everyone to become an investor and to get a foundation for lifelong success. If you've got other niches and other questions you want to hear about, please email me and I will make sure that we get them at our next podcast. So without further ado, here is Robbie Hendricks. Robbie, why don't you give us a very brief overview of your background and your bio, and we'll get right into the questions.
Sure. Yeah. All right. Well, Greg, first and foremost, thanks for having me on. Good to be on here with a fellow Buckeye. We're both Ohioans, right? But as for my backstory, well, first, I'm Robbie. I'm 41. I've got two kids. I'm a regular old guy down here in Cincinnati, Ohio. Like you said, Greg, I'm a sponsor in multifamily. So my partners and I, we buy apartments down here in Cincinnati. We look all over the Midwest, but we've been primarily just buying apartments here in Cincinnati. Like you said, Greg, we partner with LPs or limited partners and investors to buy those deals. And then, of course, we share in the upside with them. As for myself, I started investing in multifamily in 2013. Throughout my 20s, I was just in sales. I was just working like anybody else, trying to figure out what I wanted to do, much like all of us, trying to find my footing in my life. Always kind of wanted to do real estate, invest in real estate, but kind of didn't know where to start. Like I read the books. I was reading the Rich Dad, Poor Dads and the Ken McElroy books back in the early 2000s, but wasn't really sure what to do. I kind of started with a house hack. If people know what a house hack is, basically I bought a house I couldn't afford, moved a bunch of friends in, and that's kind of how I got started in real estate. Of course, I bought that house in 2007 and at the market peaks, and I lost all my money. Lost $40,000 in 2011. So that was my first experience in real estate investing. But it wasn't actually until the 2013 time. I actually was an LP myself first. So I made a little bit of money in sales. I had some savings. I knew I wanted to be in real estate. And I actually invested passively first before I actually became a sponsor of real estate deals. I actually met my two partners, Steve and Matt, very early at their very first deal. And I found something that was right for me, which was a way for me to invest in real estate without directly having to manage tenants, because I'd had a couple tenants and it was rough. Managing tenants is no small thing. Property management is a very, very difficult business. And I found my way of doing it through investing passively. I got kind of lucky because my partners were so busy managing property. They didn't really have a plan to scale. So we partnered way back then and have since after starting in very, very difficult property, very small properties, we've since graduated to having acquired over 3,000 apartments over our career. And
phenomenal.
Scale up. Now we're trying to scale up,
That's really, really awesome. So what did you major in college? Did you ever envision yourself in college doing anything like this?
No, so I was your really prototypical son of engineer parents. So both my parents were chemical engineers, Ohio Staters. So I went to school for mechanical engineering. Never did it a day in my life. Never. I immediately got in. I immediately got into sales, and I actually did go back and get my MBA when I realized that I wanted to be a business owner. I wanted to invest in real estate. So I actually went back at 29 to get my MBA. Kind of one of those I'm about to turn 30 moments, and I need to try something different. So I went back and got an MBA from Xavier. But no, I always wanted to do it, and I got very fortunate to meet the right people at the right time.
Yeah, tell us about that. Were these friends of yours that turned into business associates, or how did that all come about?
Yeah, it's one of those stories. I met my partner Steve at the gym, so I've known him for over 20 years. He was the big buff workout guy, so I didn't talk to him much at the gym because he was big and I was a scrawny, redhead guy. So I didn't talk to him much, but we eventually became friends. And he was your prototypical, I'm going to do real estate guy. Never went to college, no interest in college. Like, I'm going to be a business owner, like that guy that's sort of hardwired to be an entrepreneur. Like, college wasn't even an option, was studying real estate at night. Like, he was working construction during the day. And he actually went and became an apprentice at another multifamily firm. But he let me know the moment he was going to step out, do his own thing, like, hey man, like I'm going to get into multifamily. And he bought a 5 unit, and he was looking for investors. And I was like, man, I don't have much money, and if I did, I don't know that I'm going to be your first investor in your very first multifamily deal. But that was 2000, maybe 2010 or 2009. But no, we just were friends, just were friends. And I saw him come up, and it was really inspiring. He's a little bit younger than me. He's 36 these days, but we just got very lucky to have had similar core values too. One of those important things, when you're going to have partners, is making sure you have an alignment with those partners from a core value standpoint.
Without a doubt.
That's where I think if there's any one great blessing, it's that my partners, Steve and Matt and we have a core value alignment. So while we're kind of wired different as individuals, we'll argue, but when it comes down to that sort of root foundational belief structure, like we're all Christian guys, we're all fathers of kids, like we have those as our sort of guiding core values. Everything else just sort of flows with that. And it's kind of fortunate in that, because a lot of partnerships do not work out and it gets kind of ugly.
Oh, if we had hours, I could tell you a few horror stories along those lines from some past partners. So you kind of dipped your toe into it earlier. Do you self-manage or do you third-party manage?
Yeah, we've always self-managed. And it's not because we love property management. It's not to, I could talk about property management all day, because property management's a hard business. But ever since our very first 11-unit property in 2013, we just made the call that we were going to manage it ourselves. We just decided that no third party is ever going to manage your property with the same amount of precision and care and financial precision as you're going to yourself. So we started managing it ourselves, and of course we're fortunate today to have an executive team that helps us manage in-house.
Did anybody of the three partners have any experience in that segment?
Yeah, fortunately, both my partners, Steve and Matt, they went and got their CPM, their certified property manager designations. They did that studying. They worked for another multifamily firm together, the two of them, for 3 years before branching out. So they had experience leasing. They had experience hauling ACs to do value add renovations. My partner, Matt, his mom and dad owned 27 single families since he was a little boy. So he came up in that. So they both had real hands-on experience, like knocking on doors and collecting rent type of thing, that guided them as we got this thing started.
Do you think that you'd self-manage if you didn't have those people that had those designations and that experience?
For myself personally, the reason why this whole thing worked is because they knew how to self-manage. That's the only reason why it worked. Like I said, for myself personally, I had a couple tenants. I did have some single family rentals, like 3 or 2, right? And even managing that was more than I wanted. Like that alone was like, one of them was going to sue me because she didn't open the flue, and then smoke went out, like all these. I'm like, I'm not going to deal with this. And I was bummed. I'll be honest with you. I was bummed because I thought that real estate was the best way to generate wealth, or at the very least cash flow. But I didn't feel like it was for me. And it was just like sort of a match made in heaven, that one, I figured out as an LP. So I was an LP first, right? I figured out that I can get a lot of the benefits of real estate, like the cash flow and the depreciation and all that stuff, without having to manage tenants. Like, it was pretty cool. And when I was younger, I'd never heard of a syndication. Like, I didn't know what being an LP was. Like, you don't learn that in school, but it just so happens that my partners needed another partner. They needed someone to help them scale the company, because they were so busy managing, so busy renovating, so busy managing contractors. There was no one that was kind of on overwatch looking for, how are we going to scale up? How are we going to scale up our investor capital? They didn't even have websites. So together we kind of built the structure, and it worked out great. But the short answer to your question is no. If I didn't have partners that were competent in property management, to be honest with you, I probably wouldn't even be doing it actively.
Yeah, so it's so funny you said that. So before I started buying in partnerships, I owned some office buildings, and then I owned model homes. Mm-hmm. And I thought this would be the safest and easiest thing in the world. At the time, I'm working 60 plus hours a week doing my tenant rep brokerage business. Right. And I had every nightmare happen that could happen. So I've been speaking and teaching for 30 years around the country. And rule number one, I tell everybody, is never self-manage, both from my experience, everybody else's. But of course, if you've got somebody that's an expert in that area, that's totally a different story. So A big question I have, and again, to educate the audience, how
Sure.
did you decide to take the step from the LP to being the sponsor and the GP? And did you do that before you met these guys, or just did it kind of morph with these guys? Did you have that discussion of whether you guys should just be LPs or to take that step? Because obviously, different risk and reward. And then the second part of that question is, can you kind of go over the risk and reward from the one to the other?
Well, yeah, I'll start on how it sort of happened organically. So I was an LP in my two partners. So that was the first thing. Their first deal that they bought before we got together, I saw them do it. It was it was a great transformation that they did. They came to me and said, "Hey, we have an amazing 28 unit deal. Give us a shot." And I'm like trying to understand because again, like I said a moment ago, I didn't know what it meant to be an LP. Like, do I own the property? Like, how does it even work? Like, am I on the hook? Am I going to get sued? Like, I didn't know all that stuff. But it wasn't. But I did it, and I probably took an irrational risk because I probably gave them more money than I should have. But I got what I got as an LP was exactly what I was looking for. So what I really wanted was just what I perceived to be relatively high floor, low risk way for myself to make cash flow in a tangible hard asset because that's what made me comfortable. Like I don't know, hard assets. Just I'm sure if it was how I was programmed, my conservative parents. There's something about being able to like knock on the door and walk in that made me comfortable. And when it started going really well, like my personal LP investment, I started talking to them like, guys, like I think I know a lot of people that need this. Like it was just an organic question, like, hey, look, like my mom needs cash flow. She's retired. I don't feel like she's generating enough cash flow. Like, when's the next deal? I'm asking them, when is the next deal? Because I want to put more capital in because I want to generate more cash flow. And there's people in my life that need it. And their response was basically, bro, we're too busy. Like we're busy managing the property. We're busy dealing with the tenants and we're busy dealing with people stealing the copper, whatever, like the piping. Like he's like, I'm like, well, look, and I basically just said, well, look, if I take care of the capital side, if I can make sure the funds are available, can you guys go find our next deal and I'll make sure it's funded. And that was sort of like a handshake agreement. Like, yeah, well, if you can go find 400 grand, I guess we can go buy this 34 unit. And that was how our partnership started. And after that, it was sort of organically happened because they're like, well, we can scale, put more time into ops, and we can make sure there's a back end here with capital acquisitions. And they also didn't have any marketing experience, so I made sure there were websites. Like they had no websites, they had like no plan for lead generation. So I help with that too. But that's how it was, Greg. We kind of just fell into it, and you know, that was 3,000 units ago.
Wow. Now, do you have your Series 6 or 7, whatever license you need for all that stuff or not? No.
No. The way we file with the SEC is 506B. So while it's technically a security, we file an exemption with the SEC. There's two exemptions that people in our line of work typically file, right? There's a 506C and a 506B. 506C exemptions you can market. So you can like I could post my deals on Twitter and try and raise capital publicly. We don't do that. We don't market for investors. We just kind of do private relationships with people. So I don't have to have a Series 6 or any of those licenses to go raise capital, but we do have to have the appropriate filing with the SEC to do it legally.
Now, do they have to be accredited investors then or not?
Great question. Yeah, 506B, they do not. But you can only take a limited number of non-accredited, right?
That's right.
You can take up to 35.
Up to 35 people
that are non-accredited, and then you can take unlimited accredited. And we do have a couple of like non-accredited investors that we work with, but in reality, the accreditation rules are good. I mean, they should be there because there is risk.
Sure.
If someone is non-accredited and they're giving you $50,000, that usually represents a pretty big chunk of especially of their liquidity, right? So I tend to think we probably 95% of our investors are accredited, and that makes us feel more comfortable too for them.
Sure. Yeah. And, again, buying for 25 years, I've been maybe too trustworthy. I trusted the people that I dealt with, and I've had good experiences and bad. The two major groups I've invested with have had very good, but I've had some other fringe ones that, that I wish I probably hadn't, or asked different questions and, questioned authority a little bit more, or trusted but verified.
Right.
a little bit more. So again, part of the reason me doing this is people that are on the fence, people that don't know you personally, and that, how do you think is the best way to go about to say, okay, who should I invest with? Does it
Right.
matter what type of property or where it is? Or is it just getting the return on a quarterly or an annually basis that there? So that's, I think, a question that so many people that come to me, whether it's at a cocktail party or the golf course, saying, hey, I got 50, I got 100, what should I do with
Right.
it? I want to balance my portfolio. It's all in the stock market. What should I do?
It's tough. Yeah. And one good thing for people to remember, just high level, is that every pitch deck looks good. Every single pitch deck looks good. They all have good numbers. So the pitch deck can't be your guiding metric, right? Like, because everyone's just they're gonna put a beautiful PowerPoint together, and it's all gonna look great. And unless you're a financial analyst, you're not gonna know if they're telling the truth or not, or if they're at the very least maybe not lying or fraudulent, but maybe if they're just stretching their hopes. Maybe it's a more of a hopeful strategy rather than a business plan. You know what I mean? So I'll start with that, because if someone is trying to assess a specific deal, I think that's the wrong place to start. You have to assess the operator first, right? It's more about the track record of the operator. How have you navigated your entire careers? I mean, how many times have you lost money? How many times have you had a capital call where you had to call your investors and ask for money because you didn't budget well? And you can't be bashful to ask the track record questions to someone that's trying to share a deal with you, again, because the deal is always going to look good, right? And don't get me wrong, you should look at the deal, look at the assumptions in the deal. And I don't want to get too in the weeds with the assumptions, but basic things like, are the rents, like in multifamily at least, are the rents that you're projecting reasonable? Is the rental growth you're projecting reasonable? Are you projecting a rosy macroeconomic picture, like with interest rates? Like, are you assuming interest rates are going down? Because that's a hope. That's a hope, and hope is not a strategy, right? You have to assume the market is going to get worse, okay, to stress test the deal. You have to assume you're going to go through a bumpy patch. Is the deal strong enough to cash flow through a rough market? But that's all like after you've assessed the sponsor or the GP. Those are equal terms, right? Sponsor, GP. You want to assessing them first and their track record, and that should be done on the phone or in person if at all possible. Like, you can't just invest with somebody because you see a great PowerPoint, because they all
Yeah.
look, they all
Are
look.
you the person doing that for your group?
I tend to be the first point of contact. So if someone wants to like get to know us and get to know what we do and talk about our track record, yeah, I'm typically the one that hops on the phone or hosts them at the office. If someone comes down here, they want to come to Cincinnati, then we'll all three of my partners, we'll meet them all. You
That's
know,
great. I
yeah,
think that's a huge point. So, you said about all these unforeseen things. So I've had three this year hit me like a ton of bricks from outside that none of them you could have planned for. One, the insurance went up on the project 400%
that's
because
nuts.
because it was in a hurricane zone and we went from making money to losing money.
Yeah.
One, we had 70 people falsify their financials. And
Oh,
and it was in Houston, and the judge in Houston was tenant friendly. It took us a year to get them out of the property.
that's a disaster.
And then the third one was in Arizona. Two people built projects, and it was so soft the market, the Class A had the discount that the wasn't very much difference between the value add property I was invested in and the brand new ones. So we had a hard time getting it leased up or staying competitive with the lease. So there's three things with three good operators, happen to be the same operator for all three, not the same property management company, that out of the blue you think we're going to make money. All good markets, by the way,
Yeah.
where we didn't. So for me, knowing the pitfalls and being able to disclose those up front of what is the risk, no matter if you put in 10 grand or 10 million,
Yeah.
that people need to know. And tell us about like your average hold period on a project. So you're doing value adds, right?
Mhm. Yep.
So explain to people what a value add is versus a typical one, number one.
Sure. Let me touch on the last thing you said real quick with those deals that were struggling. If you're ever going to just assess a deal, the big word that you want to talk to the sponsor about is the word assumptions. What assumptions are they making about the deal and the market and the exit? Those are some of the most important questions you can ask. And you want to make sure that there's a market mastery there. Because a lot of people got involved in this business over the last 5 or 6 years that hadn't really operated before. Multifamily became a very hot business, a very sexy business to get involved in. And a lot of people raised a lot of money that didn't particularly know what to look for. Like I saw so many deals in Austin and Phoenix where the rent growth assumptions, there's that word, assumption, was over 6% a year. And this is after rents had already grown 30%. Like those deals, all you'd have to do is a median household income assessment compared to rents to know that those rents were impossible. But people were living in this sort of euphoric, it happens in everything, right? They got euphoric about Nvidia, they got euphoric about Bitcoin. Like people get euphoria and they just buy. So it's really important if you're going to invest with someone. And don't get me wrong, I have a deal in Dallas I invested in as an LP with someone I really trust, and transparently, I'm going to lose all my money. Like,
Yeah,
I want,
no,
I want
I think we've all unfortunately
yeah.
had that. So I'm sorry, go on.
Well, no, it's like, and it's, again, because I felt the urge as an LP, not a sponsor. I mean, it's LPs and GPs. I felt the urge as a LP, like, man, I own all this real estate in Ohio. I need to get some exposure to the Sun Belt, And then I go in on a deal in the spring of 22, and I didn't think they were going to use variable rate debt. Of course they did. The Fed raised rates 200 basis points within 6 months. Deal was basically dead. I mean, just like that. Rate cap blows up. Anyway, it's nerdy stuff, but it does go to show that there's risk here. Greg, I already forgot your last question because I got so caught up.
Yeah, I know. We're going to do a lot of things here, so I hope people can keep it straight as well.
I'm sorry.
The normal hold period.
Yeah, value add.
For the value add.
That was your question. So what value add is in our space, just a high level, we're looking for opportunities, we're looking for deals where we can add value and force appreciation. What's that typically look like? Obviously, that typically looks like renovations. So we'll start with, a lot of times we're buying deals that have never been renovated or they haven't been renovated for a long time. So they're all dated amenities. They look like they're old. People are obviously not willing to pay market rent for something that is old, or even worse, maybe it's distressed. Maybe there's actual serious deferred maintenance issues. You'll get that in Class C property a lot. Obviously, you'll have roof issues or mold issues and all that really fun stuff that, while on the surface is terrible, can really sometimes be an amazing opportunity because a lot of people aren't willing to do that work. Of course, another value add you can do is just having good management. You would be surprised how many great apartments are being run very, very poorly by either out-of-state management, out-of-state, out-of-mind type of thing. You have a lot of out-of-town owners in all these markets that they're not boots on the ground, so they really don't know how things are running. They don't know that their rents are way below market, or they don't know that their service is lacking. So we're looking for all that stuff. We're looking to come in and truly transform a property, whether it's just because it's stale and dated or because it's truly distressed and we can completely revitalize a community. We've kind of done both. And that's what we're looking for. Hold periods sort of vary based upon class, at least in our strategy. Everyone's a little different. If we're buying a nice, what you would say B class property in a nice working class area, well, that's the type of thing we might want to hold for quite some time. If there's good schools and good jobs, I mean, we might want to cash flow that for 10 years because we're bullish on the sub market. If we're buying a heavily distressed property in a C class area, maybe a little rougher, maybe a little bit older, they still need good housing though. People pass judgment on various classes, but everybody needs a clean, affordable, safe place to live. But we just might not hold that as long, if we're not as bullish on the sub market. So we might hold that for 3 to 5 years if it's more of a Class C property in an okay area.
Got it. Do you guys do 1031s at all?
Yeah, we're actually doing one right now. Yeah, we're trading out of a property, a portfolio of properties we've owned for 6 years. Our investors have long had their money back. They got all their capital back years ago, but just decided it's time to take the gain and move it into a new deal with some fresh upside.
See, that's wonderful. So the other groups that I've dealt with, being the 506C, it's a lot harder because everybody in the partnership has to invest in there. And we had one not far from you in Northern Kentucky that we made almost 4-to-1 on our money. and we didn't have a flip, so we paid Uncle Sam a heavy. We held that one almost 15 years too.
Oh boy, so you had a lot of
we
recapture,
we had a
depreciation.
lot of recapture, so
Yeah,
that has been the only negative. You can't bitch about making money, but wanting to shelter it as much as you can. I've also bought some properties in IRA, to shelter there. Are you seeing many investors doing that? Invest.
yeah, we have quite a few folks that use self-directed IRAs to invest, and they come with some additional headaches. Like all good things, they come with some additional headaches. You have to send in fair market value statements, some stuff like that. But we have a couple custodians that we really like, and people that want exposure to multifamily in their IRAs. It's a really good vehicle to do it.
Got it. What are some other crucial items that investors need to look at and know today before they're investing? I know that's a toughie.
Well, I'm always going to go back to, well, one, investors just want someone they can trust, right? I mean, I've talked to obviously now, like, whatever, hundreds of investors. I think we've raised maybe $120 million, so I've talked to a lot of people, and the common theme is just, goodness, I just want someone I can trust. So the question, if you're an investor, you have to be just very, very, very open to asking every question. Every question, you might think it's a dumb question. Ask all the dumb questions and just vet how transparent the sponsor is. I mean, that's one of the most important things. Is just you just need to feel good that you have someone that's going to communicate with you. The books are always open. The office is always open, and you have someone that's going to be transparent with you as your investment unfolds. And that's what I think is most important. And if you don't get a good feel from someone, if someone's not willing to answer questions about, you should always ask them, tell me about your worst deal. Tell me about the worst deal you've ever done. Tell me why it went wrong. And if they don't take ownership for why it went wrong, I would say no. To me, it's a major red flag.
Or if they don't admit they've had any issues.
Correct. Even if so we've done 29 deals full cycle, right? And we've never lost money. We've actually never missed our pro forma. But that doesn't mean that we didn't learn lessons along the way. So I try and make sure when I talk to a prospective LP, I'm like, here's some mistakes we've made though. I mean, we managed to buy with enough margin that it didn't end up materially impacting the deal over the 5-year hold. But yeah, like we've had hiccups. And I try to explain like the hiccups we've had and what we learned from it.
Well, that's good. I can tell. So I know a couple weeks ago when we were chatting, I told you about that book I read, what I thought was the best one I ever read, The Hands-Off Investor by Brian Burke.
Yeah.
Weren't you going to visit him?
Yeah, I was just with him. I just spoke with him at a conference 4 days ago.
So for our listeners out there, I can put it up here. It's not going to probably show very well, but The Hands-Off Investor. Oops, it's not coming up at all. I apologize. The Hands-Off Investor by Brian Burke. If you email me, I'll send you a copy of it. I mean, I've got almost 40 years doing this. I've taken every class known to mankind, CCIM and otherwise. This book is hands down better than all of those combined. A lot of the questions that you're talking about, the very tough questions they ask the sponsor about things on interest rates and lending, that certainly from a real estate broker's perspective, we were never trained on, ever. Right. The very good stuff that really opened my eyes, that it told me, both as a broker and an investor, that I've been too trustworthy not asking those tough questions to people. And it's like, thank God more of them didn't go bad, not asking those questions are the same things that you were saying there. What else do I have here? Okay, here's one from kind of off the wall in a different area. So I mainly represent office tenants on their lease renewals and relocations. How has the work from home since COVID changed, if anything, occupancy in apartments or your leasing?
Work from home specifically for us has only changed little things like, so our occupancy has been very consistent. Now that's more of a function of the fact that I think we're pretty good at managing, and it's a sub-market thing. Like our sub-market here in Cincinnati, I mean, not to get in the weeds, like we're just still undersupplied here. So we're at 95, 96% occupancy portfolio wide. It's hard to glean how much of that, if any, has to do with work from home. It might just be the nature of our sub-market. But we have had a lot more amenity requests, especially in our B class properties, the people that would typically be your entry level, mid-level, sort of white collar, the work from home types. They want more amenities that support that. So what they want is they want bigger business centers. They want quiet rooms, podcast rooms. They almost, to a degree, they want the clubhouse to be a co-working space. So we're
Interesting.
so we're seeing a lot more of that interest, and we're converting, especially some of the newer acquisitions we've done that have clubhouses, and we're about to build a brand new like 5,000 square foot clubhouse at a property that doesn't presently have one. And it's now so much thought is now going into the fact that there's actually going to be people in there. Like it's not just like a place where prospective tenants go for 5 minutes. Like no, these people want they want a conference room. So we're putting a conference room in it with a whiteboard and a TV that they can rent out to use for meetings. So that's actually, if anything, a relatively big opportunity. But I'm seeing quite a bit of that. The biggest thing that we see impacting property management is AI.
Well, that was my next question. So it leads right into it. How has AI affected your business, good, bad, otherwise?
So it's like the Wild West right now. There are so many new offerings from an AI standpoint that'll handle maintenance calls, reaching out to tenants, building relationships with tenants, being a first point of contact for tenants. Like we're piloting a software now that is proactively texting every tenant that we have, introducing itself, hi, my name is Sarah. I'm your new remote assistant. I just want you to know if you ever have any issues at all, you can text me. And we can see the transcripts of these conversations with tenants, and it's indistinguishable between
And how is it expensive?
no, it's like $1.50 a unit a month. We ran a pilot at one property where we averaged 50 calls a day, 50 phone calls a day, and it went down to 15 because
Wow.
they're just texting Sarah now and saying, "Hey Sarah, I have a maintenance issue. Can you coordinate it?" The AI automatically connects to our property management software, schedules the maintenance request. Our manager is never even bothered by it. So what I would say is a concern, this has far-reaching implications on employment. So if we were going to try and go more bigger picture, we're currently estimating, and I'm not sure how this is going to work, that we could have a reduction in staff by 30%.
So that's going to improve your bottom line, though,
Yep.
significantly.
So for us, it improves the bottom line, and it is improving customer satisfaction through less people. But then you also have sort of a more macro concern, which is, well, this is just property management. Any customer service is up for grabs. Those low to mid-tier white collar jobs, maybe more the generalists, they're in trouble.
They're gone. Yeah.
And that could have an actual long-term negative impact on occupancy, right?
Yeah. I didn't think of that. That's a great point. So from my standpoint, if I'm negotiating an office lease, I negotiate the business terms. I don't want to play lawyer. I don't want the liability. So I always want a lawyer to be involved. So I always think on anything AI, how is that going to affect whether you're the owner, your general partner, limited partner, whatever, and the tenant? If you can get the tenant to sign the lease quicker and all that, great. But yeah, I didn't even think of that as far as, less people around to do it. I mean, I could see legal paralegals going away. I could see a lot of that. So I think the world is changing so fast, but I certainly didn't think about because like Columbus is underbuilt like 10,000 a year the last 6 years. So like you, it cost a lot to build new, but there's definitely not enough apartments. I'm sure Cincinnati's very similar in that respect. Are you doing anything downtown, or are they all suburb markets?
Yeah, we're all suburb markets. That's where the people are going. Columbus is different in that regard. Columbus is it's thriving downtown. You're just directly adjacent to Short North and Ohio State. Cincinnati downtown is just all kind of corporate. We try. I mean, not to get in the weeds on Ohio, but the Banks is popular down on the river, but the suburbs are what's growing around here. So that's where we're.
What about Northern Kentucky? Are you doing anything down there?
Would love to. Northern Kentucky is Cincinnati, right? Like we really should just annex them because they're all Bengals fans, But we've had a couple of deals on the hook down there. It never went through, but we're looking at Northern Kentucky just as much as we are Cincinnati and Columbus.
Got it. Okay, so that wraps up the main things I wanted to discuss. Is there anything else you think that today an investor should know, whether it's apartments or anything else? You've given us a phenomenal overview, first of all. But is there anything else I've missed question-wise to ask you that you think people ought to know?
Well, I guess I can just give a general like what I would take away. The last 4 years have been very difficult in multifamily. A lot of people got over their skis. We were super conservative and we came through the whole thing unscathed, which is great. We see right now is a we see like a window right now of opportunity in multifamily to buy some really great product. There's going to be distress in our space. So I think if I was talking to a prospective investor that's like looking at a bunch of different sponsors, I would be careful to be very clear about what they have going on in their portfolio right now, because I think a lot of people are going through distress, might be kind of quiet about it. That's just, I would be careful because if a firm is going through distress, they're probably not making great buying decisions. So I would be careful out there. It's kind of a tough time. A lot of LPs have had a really, just kind of like what we discussed with our own personal investments, Greg. Like a lot of LPs have had a rough go the past 4 or 5 years. They trusted a lot of people. There were a lot of beautiful PowerPoints, a lot of beautiful pitch decks out there that didn't come to fruition. And but I still think that like, look, being an LP and being a GP in multifamily changed my life. Like it was.
Well, I could tell just from listening to you the confidence enough. I mean, it's a big step. It's a lot more risk, obviously, for you. A lot more headaches, attention to detail. What are the size, to give our listeners a little bit more about you and your company? What are the size projects are you doing? 10 million, 20 million, 30 million? How big are they that you're dealing with?
Yeah. Our most recent acquisition was a 3-property portfolio that was 70 million. Each property itself was, I think there was a 30, a 30, and a 10. These were a 240 unit property, 192 and 128. To be transparent, we're a little bit like class agnostic. We just want to buy great opportunities that are priced right.
So are you doing new ones as well as Class C then?
We're doing a C and B, and then we would love to buy like if a dream deal is like a B property in an A location, right?
Yes.
I can go in there, buy a B property at a great basis, beautify it, and then I'm going to slot way under the A class rents. And that's exactly what we want to do.
And when you're buying it in a LLC or a partnership, what do the banks want you to put down today? How much do you typically have to put down?
On a loan, we always go in at a low LTV compared to what a lot of people do. So our highest LTV is 65%. So we're bringing a lot of capital. Again, that's how we sleep well. You know, you go broke by taking on too much leverage. So we would rather raise more capital and then do a cash out refinance later after we've done the renovations, increased the income, then we can do a cash out refi and return capital. So like that $70 million deal, we raised $44 million.
Wow.
Which was hard. It was hard.
Now, are you holding back 5-10% for reserve fund, or are you getting a loan then to cover the value add?
It all depends on the deal. So on some deals where we're getting a partial loan for the renovations. Sometimes we're raising all of it. The big deal, the reason why that one that was 70 million, we raised 44 is we were doing loan assumptions. So, and we didn't want to take a supplemental loan, nerdy stuff to do the renovation. So we just raised it all. It was difficult, but now we're 2 years into that deal and we're going to do our refinance now and return 50% of the capital.
Wow.
So the 44 we raised, we're going to send back 22 million.
So you've had a phenomenal turnaround then on that project. Give us the listeners your website so they can reach you.
Sure. Yeah. Website's just vrec.com or vrec.com. And if anybody wants to say hi, my email is just robbie@vrec.com.
So that's easy enough. Robbie, I can't thank you enough for your time and your expertise today. You've certainly taught me something, and I look forward to investing with you in the future. And I do have a lot of contacts down there. It sounds like you've probably got plenty, but we've got a lot here. And as I said at the beginning of the podcast, my goal is to educate people to get them more comfortable in doing this, because I've got a lot of friends that are stockbrokers and financial planners, and none of them invest in real estate. None of them feel comfortable because, quite frankly, nobody gets taught this stuff. Right. Even if you do, is again, I said, I've taken 200 hours of post-grad probably. A lot of it doesn't scrape the surface of some of these things that we've discussed today. So hopefully everyone out there, we have wetted your whistle to learn more. Please email me and let me know what other questions you've got, what other areas you've got. Again, Robbie, Thank you so much here for your time and attention today. And I will forward you a copy of this as soon as we're done editing everything. And hope you have a great rest of the summer.
Hey, thanks so much, Greg. It was fun talking shop, man.
All right, everyone, have a great day and God bless.